Whether you're a financial professional that likes to run your own illustrations, likes to do your own case design, or maybe you're a financial professional that just wants to know if your IMO screwed up your IUL illustration or not, this video is for you. My name is Charlie Gipple. I'm the owner of CG Financial Group, your independent marketing organization based out of beautiful tropical Des Moines, Iowa. Remember, if you like this video, to subscribe to my future juicy videos like this: sales ideas, sales concepts, estate planning, tax planning, all that good stuff. Make sure you subscribe. Also, make sure that you click the thumbs up. So here is an indexed universal life insurance illustration. I'm not going to go into the exact details of what I illustrated, but what you see here is $10,000 per year going in, and I did that for, well, from age 45 to age 65. So why is it that this illustration software is chopping down the premiums going into the policy in year 5? Well, this is where we talk about those numbers that maybe you did not know actually meant something here. These numbers here that are kind of coded, these numbers mean something. That 7-pay number, that means something. The guideline level annual premium, that means something as well. The guideline single premium, that means something as well. And what is that T over there? That is target premium. Folks, all that target premium is that is how you are paid. That is the amount that you are paid full commission on. Anything beyond that target premium that comes in year 1, unless it has rolling target premiums, the product does, that is what you are paid on your full commission. Anything beyond that, you are paid excess commission. That's all target is, folks. It is a calculation in how your commission is paid. It doesn't mean if you pay that, the policy is going to run forever. Nothing like that. So here's a situation here. The 7-pay premium is call it $10,000. The guideline annual premium is less than $10,000. The guideline single premium is just one single premium to the tune of $47,000. Okay, Charlie, so why do you see that $10,000 dropping in year 5? Quite simply because the way that I ran the illustration was what a lot of people do. Well, even though I want to pay it for a 20-year period of time until my client's age 65, for instance, I want to solve for the minimum death benefit running at the 7-pay premium. That is why you see that drop off. Now, okay, but that still makes no sense. Why is there the drop off? This is where I'm going to go to my whiteboard here and talk about guideline premiums. So with TEFRA and DEFRA back in the early 80s, what Congress has decided, what they decided back then was, you know what? You cannot have a death benefit of this and fund the policy of this. You cannot do that. Why? Because it's merely just an investment at that point in time, and therefore we need to put parameters around what is a life insurance policy. What's the definition of a life insurance policy? So what Congress said was, hey, for a given death benefit, let's say that's the death benefit, we are going to create the notion of guideline premiums as well as cash value accumulation test. For the most part, when it comes to cash accumulation, usually we choose the guideline premium test. Not going to go into CVAT today, but what is the guideline premium test? That is what defines a life insurance policy. The insurance companies will not let you break the rules of the guideline premium test. Well, what are those rules? What Congress has said was, for this given death benefit, you can put no more into this policy than a single premium, and that single premium, maybe that single premium, depending on the death benefit, in my example, it's $50,000. Now, what if you're not looking for a single premium? What if rather you want to pay it on an ongoing basis? Well, that is where for that given death benefit, we will say that each year, off into perpetuity, you can put in, say $10,000 per year, for example. And that is called the guideline annual premium, in which in our example is $10,000 per year. Now, here's the situation though. Can the client put in $50,000 in one big lump sum? Absolutely they can. And it would still be classified as life insurance, right? What if the client wants to put in $60,000? The insurance company will not allow that to happen, at least with that given death benefit, because it would not be classified as life insurance. It'd be classified as an investment. The life insurance company won't let that happen. Okay, Charlie, so can we put in $50,000 year 1 and then year 2 put in, say, $10,000 on top of that? No, you cannot. Here is the calculation. Congress has said that you can put in no more than the guideline single premium or the cumulative of the guideline annual premium. So year one, you have 10,000. Year two, 20,000. Year three, 30,000. Year four, 40,000. Year five, 50,000. Year six, your cumulative premium that you can put in to be classified still as life insurance in year six is $60,000. So guess what? In that sixth year, if you wanted to, you could put in $10,000. So in the meantime, what you've done is you've leveraged the guideline single premium. Even though you went beyond the guideline annual premium, it's still considered life insurance, right? But then in year six, once you start to get those guideline annual credits, so to speak, above that $50,000 single premium, you can do that. You can fund that policy at that point in time, and it's still considered life insurance. Okay, so that's not all that there is, because later, a couple years after TEFRA and DEFRA, you had TAMRA. And what TAMRA said was in 1986, 1988, it's either 86 or 88. I always forget which one it is. But what TAMRA said was, okay, but it's still not good enough for us. We need to put in another level of premium, and that level of premium would be that death benefit, for that death benefit to be paid up over, say, over 7 payments, what is that premium level to pay up that death benefit effectively over a 7-pay premium? And maybe that premium amount is $15,000, right? Okay, so what does that mean? Well, that is the modified endowment contract level. And what that means is if you go beyond that modified endowment contract level within the first 7-year period of time, for example, put in $50,000 in year one here, that policy is a modified endowment contract. What is a modified endowment contract? Modified endowment contract is a life insurance policy still that is taxed like an annuity effectively. So you have last in, first out tax treatment. The gain comes out first. A modified endowment contract means that your loans are not tax-free. A modified endowment contract, let me ask you a question. The question is, does the beneficiary of a life insurance policy care if that life insurance policy was a modified endowment contract or not? They don't, because modified endowment contracts still have tax-free death benefits. So a modified endowment contract is a life insurance policy that then becomes taxed like an annuity, with the exception of the death benefit, because the death benefit is still tax-free. Okay, so we cannot fully utilize the guideline single premium if we do not want the policy to be a MEC. That means, Charlie, what you're telling me is we have to put in, certainly within the first 7 years, no more than $15,000, right? So that's correct. $15,000 year one, $15,000 year two, $15,000 year three. However, you will get to a point here to where that $15,000 is going to bump up beyond the cumulative of our $10,000 and the guideline single premium. And that again is when you're going to see that illustration drop down below what you were trying to illustrate. Say in my previous example on the Allianz illustration, $10,000 per year. Why is that? Because maybe you asked the illustration software that you did not want the policy to become a MEC. I'm fully cognizant I'm going through this very quick. Some of you will get it. Some of you will have to rewind this, which is absolutely fine. So what did we do here? What I asked for was, hey, for 20 years, I want the minimum death benefit at the 7-pay level. I want to pay that 7-pay level for 20 years is what I said. And by the way, some quick math here. Okay, so that means that $10,000 per year, $10,000 per year. So I'm funding it above the guideline annual premium level. That means that I can fund that $10,000 per year, but somewhere in that fifth year, I'm going to be bumping up against, because 5 times $10,000 is $50,000, which is more than $47,000, right? So that means in that fifth year, what you're going to see is the illustration software is going to limit you. Now, let's go up and see if that is correct. So I'm going to zoom out, zoom back in, and you have here, I'm going to zoom back in now. You have here, yes, Year 1, year 2, year 3, year 4, it's bumping up against that $47,000. So what's happening? What's happening is we do not want to exceed that guideline annual premium level or the guideline single premium. They both interplay together. The insurance company is not going to let you exceed that because then it's not considered life insurance. And that is why you have this funky treatment a lot of times, or the funky printouts on the illustration software. Like, why is it reducing me? I'm asking for the 7-pay premium to be paid forever. No, what would happen, what should happen is you should ask for the guideline annual premium to be paid forever. And what it would do is it would say, okay, $10,000 to be paid forever, to not cut down beyond year 5, for instance. That means that you're going to have a death benefit that is slightly larger, and it will run that $10,000 out for that 20-year period of time. In short, by choosing the 7-pay forever, it's dropping us down from a premium standpoint. Why is it doing it? Why is it doing that? Well, heck, I just explained why it's doing that, right? So again, these numbers, these codes on the illustrations, they do mean something. And when I'm designing a case or looking at a case that somebody else designed, I can know if the policy is maximized or not. For instance, it has a gazillion-dollar death benefit. The client wants all cash value. Well, that means that we want to be able to fund that gazillion-dollar benefit at the maximum level. So I go down here and I say, well, on that gazillion-dollar death benefit, we're only putting in, say, $20,000 per year. Well, if the guideline annual premium says that we could otherwise be putting in $100,000 per year, for instance, one of two things needs to happen. Number one is you need to put in that larger amount of premium if you want it truly optimized for cash value. Or number two, do what? Decrease the death benefit. So you are bumping up against these maximums, but not $1 beyond those maximums. Folks, very fast video. I know. If you like it, give me a thumbs up. If you like it, subscribe. If you didn't like it, what can I say? I tried.